So I am so glad to be joining you guys, and I'm glad you're joining me here today. For those of you who may not know me, I am Brianna or Bree Beers, and I own the recently rebranded Bree Beers and Associates, formerly Lipa Beers and Associates. I'm not sure how long I get to say recently rebranded. We rebranded in June, so still new. So at Bree Beers and Associates, we help small businesses and individuals with tax prep and tax planning. I love tax planning because that's where we get to strategize with our clients and help them minimize their annual tax burden and figure out ways to take that money that they saved and reinvest it into their business and into themselves. So you guys might be watching this in a variety of places: YouTube, Facebook, Instagram. I don't think I'm on Instagram yet. Let's ignore that. But if it is not in our awesome Facebook community, Money, Taxes, and Finance, and you are a business owner, please go hop on over there and join that group. It is an amazing and supportive community of people and small business owners just there helping each other, and we're in there to help you as well. So go over there and join that. And if you're new to our Money, Tax, and Finance group, we have 2 live sessions a week, usually. Mondays, right now, at 10 a.m. Mountain Standard Time, we have weekly trainings. And then usually on Fridays, we have our updates and Q&A sessions at 2 o'clock Mountain Standard Time. So today is part 3 of our series on how to pay yourself as a business owner. So today is for those of you whose businesses are set up as partnerships. All right, today is for partnerships. So a partnership, you guys, is any of you out there who have started your business with at least one other person. So there's 2 or more of you who started a business and you've not incorporated it, meaning you haven't made it a corporation, nor have you made the S corporation election. So if you have not incorporated or made that S corp election, partnership is where you default to if you have 2 or more people who started your business together. With new locations come new sounds. We are pretty close to the airport out here, so if you hear the airplanes like I do, vacation. So you guys, if you're not a partnership, if you're a corporation or an S corp, we talked to you guys last week about how to pay yourself. And then if you're one of my lone wolves out there, a sole prop or a single member LLC, then go back 2 weeks, because that is when we chatted to you guys about how to pay yourselves as business owners. So today is for my partners and my partnerships. And if you happened to watch our training 2 weeks ago for my solopreneurs, then you will notice a lot of similarities when we talk about partnerships today. And that is because, so when you set up a business, if there's 2 or more of you, right, a partnership is where you default. If there's only one of you, a single member LLC is where you default to. All right, so there are a lot of similarities in these default entity setups. And I will point those out as we go along. And there are also some similarities with partnerships with the S Corps that we talked about last week. So I'll kind of point those out as we go along. Let's just keep on trekking on. So the first thing when you're in a partnership that you need to remember is there are 2 types of payments that may go out to partners, okay? And the first one we're going to talk about is paying the partners who own your business for the work they do in the partnership. So these are usually your general partners, sometimes your managing members, whatever it is. But if there is a partner who owns a piece of the partnership, but they're working in the business as well, how do you pay them for working in the business? Because you really, guys, when you're talking about a partnership, there are 2 ways to pay out your partners, right? There's distributions for kind of, that's kind of how you pay out on profits. Hey, we made $100,000 and we want to pay out on that this year. That's usually paid out through a distribution. Then there are partners who do work in the business who you want to pay them for the work they do in the business, kind of like wages. So that's what we're going to talk about first, is paying the partners who work in the partnership for the work they do. So first and foremost, just like my solopreneurs, you do not put yourself on payroll. If you are a partner who owns a partnership, you do not put yourself on payroll. All right. You can still have other employees who are W-2 employees on your payroll. You just aren't one of them. Okay, so instead of receiving W-2 wages, you are going to receive what's called a guaranteed payment. So your guaranteed payment is what you receive, the compensation you receive for doing work in the partnership. Okay, and usually guaranteed payments, maybe not necessarily the amount, but sometimes even as detailed as the amount. The partners who should be getting guaranteed payments, that's usually outlined in your partnership agreement. The reason guaranteed payments are called guaranteed payments is because they are paid out whether or not the partnership makes enough money to make those distribution payments to all partners or not. So what we're saying there, and once we talk about distributions, this will all wrap together, okay? But your guaranteed payments are to the partners doing work in the business in order to help the business, the partnership run. And these guaranteed payments to your partners are a tax deductible expense to the partnership. All right, so that is kind of how they are similar to W-2 wages. The biggest difference between guaranteed payments to partners and W-2 wages to an employee is that the guaranteed payments, the partnership doesn't pay any payroll tax on that. So when you pay W-2 wages to an employee, or if you're an S Corp and you pay your S Corp officers W-2 wages, as the business, you're paying the wages, which are tax deductible, but you're also paying part of the employer portion of payroll tax, which is a tax deductible deduction, tax deductible expense. But these guaranteed payments, okay, the business is not paying any payroll taxes on those guaranteed payments, okay? And we will circle back around to this again at the end, okay? But what you want to get from here is partners who are doing work for the partnership, working in the business. This is your, if you're running admin, if you're running the business, you should be receiving guaranteed payments as compensation for the work you're doing for the partnership. And then that is going to be called a guaranteed payment, and it is going to be a deductible expense to the business. All right, and then it'll be income to you as a partner on your individual tax return. So that is one way that partners get paid from a partnership, is if they're doing work in the business, But what about, we talk about, a lot of times it's called profit payments, or I can't think of other things it's called, but your distributions to your partners. And this is at the end of the year, when you're in a partnership, let's start easy. Let's say there's two of you and we're 50-50 partners, okay? At the end of the year, you're like, oh man, we made $100,000. And you pay that out in cash to each of the partners. You give each partner $50,000. That's a distribution, all right? And those distributions, those are kind of like, almost like it's on money that's already been taxed, so there's no tax consequences on those distributions. And this is especially important, maybe not necessarily in those 50-50 partnerships, because a lot of times those 50-50 partnerships are going to have a piece of guaranteed payment in there because each of those two partners is probably doing work in the business. But let's say you're a partnership because you needed an investor, okay? So let's say you're doing all the work, but you have a partner who who gets 50% of the profits. In that case, I'm getting those guaranteed payments, and then we're doing a 50-50, if our ownership in the partnership is 50-50, then at the end of the year, if we're doing any sort of profit payout, then we're doing it at our ownership percentages. And there's a lot of partnerships that are set up, maybe they have one or two general partners who are running the business and are the majority owners. But let's say they might have a lot of smaller partners who are investment partners who just own maybe 1, 5, 10%. So if you're in charge of calculating the partnership payouts, we're going to talk to you in a second. But it's important to understand the difference between those guaranteed payments and paying out the profits, or the kind of the return of investment, or paying out. I think of all the different ways you can call that. But like I said, this money is paid out, and those distributions are not a tax deduction to the business, to the partnership, nor are they considered income to the partner typically. Okay, there are a few exceptions to that, but we're not going to talk about that. We're going to talk about a properly run partnership. Those distributions are not going to be taxable. And again, those distribution rules are going to be outlined in your partnership agreement. There's going to be something in your partnership agreement that says distributions are made based on ownership percentage. Profits are paid out based on ownership percentage, something like that. When you're paying out those profits, you guys, basically what you're doing is that whether it's at the end of the year, maybe you flip properties, and after each property is sold, maybe you guys do some sort of profit payout. Whatever system you've set up in your partnership, you want to make sure the payouts you're paying out are after you've paid all of your expenses, any of your liabilities, obligations, okay? And you want to make sure you're keeping enough cash in your accounts, okay, for those emergencies, and we will circle back around to how to do that. But basically, it's whatever money's left in the bank account, that you want to distribute out to partners. That's what we talk about when we say paying partners out their distributions. The biggest question you guys have is, when do the partnerships pay their taxes? So partnerships do not pay income tax, okay? Partnerships do not pay income tax. Partnerships are what's called a flow-through entity. So your partnership is going to make the income, they're going to pay the expenses, right? And when all is said and done, at the end of the year, whatever taxable income there is, that's going to be reported and trickled down to the individuals, to the partners. And the partners are going to report that as income on their tax return. So that's similar, if you listened last week, to how an S corporation reports their income. Okay, so let's give you an example. Let's say your partnership made $200,000 this year in revenue, okay, all the money they brought in, and you guys spent $100,000 on expenses. Okay, that leaves you with $100,000 of taxable income for simplicity reasons, okay? So that $100,000 is your business's income, your taxable income. And then it's allocated based on ownership percentages. So if you have owners that are 50-50 owners, each owner would get $50,000 in taxable income reported to them on their K1. If you had maybe you have 10 partners who each own 10%, okay, then each partner would have $10,000 of reported income. Okay, whatever your ownership percentage is based on your partnership agreement is how much of that income is going to be allocated to you to report on your personal tax return. That income is going to be reported on line 1 of your K1. So just like you receive a W-2 when you're a W-2 employee, when you're a partner in a partnership, you're going to receive what's called a K1, and that's what's going to report to you on the individual level what you need to report on your tax return as income. And it's kind of comparable when we talk about sole proprietors, right? And we talk about Schedule C, line 31, that's your taxable income. Same thing here. Line 1 of that K1 is your taxable income as a partner in the partnership. We like to think of it as your portion of net profit or taxable income. All right, and then on that same K1, line 4A is where your guaranteed payments are going to be. Remember, if you are receiving money, compensation for your work inside the partnership, that's a guaranteed payment. And that money is what you receive for working in the business, for generating income, right? So on the individual level, as a partner in the partnership, I am going to look at line 1 and line 4A on the K1 that I received. And that is going to be overall my income that I'm going to have to report on my individual tax return. Okay, and that's going to be subject to not only my income tax, but that darn self-employment tax as well. So your partnership portion of income, line 1, and your guaranteed payments, line 4A, are all subject to income and self-employment tax. So then finally, the last piece of information on your K1, line 19, that's going to show your partner's share of distributions made that tax year. Okay, and remember, those distributions are usually based on your ownership percentage. Generally, they're not a taxable event, so there's no income tax or self-employment tax on those. That comes out essentially of your portion of profits, so it's already been taxed. That's why there's no tax on those distributions. If you are your managing partner, you're in charge of deciding how much to distribute out to each of the partners at the end of the year. Let's talk about that because that's really important. Okay, because we have so many partnerships who come in and they just, at the end of the year, whatever cash is in there, they're like, okay, distribute it out. Okay, but no, let's not do that. That is not a good business practice. So let's slow down just a little bit. All right, so I advise building up and leaving a cushion in your business of anywhere from 3 to 9 months of expenses. Okay, and I will circle back around to how we want to do this. We call that your emergency fund, your emergency reserve. This all comes down to your comfort level, your risk level. I'm going to say, my goal is to get 12 months of reserve, especially in this craziness, of COVID, knowing now that, something like this can happen. I would love to have 12 months of expenses saved up for a rainy day. All right, but anywhere minimum of 3 months. Okay, and that depends on your risk tolerance, okay? I also recommend putting this in a separate bank account, all right? Out of sight, out of mind. So now you're like, okay, so we have our bank account or our expenses, our emergency fund, we're good. I have this chunk of money. I know how much how much cash I have to distribute out, okay? How do I do this? So my first suggestion, step 1, we'll call it step 1. And this is, I always suggest you distribute out at least enough that you're going to cover a good chunk of their payroll tax or your partner's taxes that they're going to have to pay. So let me back that up, okay? So you can do this as a one-time payment. You can do it at the end of the year. You can do these at the end, like I said, if you're flipping houses and you have a big sale, or you build houses and you can do this at the end of every sale. some sort of system. But at the very least, most of my partnerships that I work with do it at year end. Okay. And at year end, they come into us at the partnership level and they say, okay, what are we looking at? And we say, okay, you're looking at, we're looking at about $100,000 in taxable income this year to the business, at the business level. Okay. 100,000. And then that 100,000 is going to be allocated to each of your partners. Okay. You with me? So let's say you're 50-50, right? Let's say you're a 50-50 business owner and you guys have $100,000 in net income. So each of you is going to have $50,000 of income to report on your business. But without a distribution, how is each partner going to have the cash to pay those taxes? So if you're not making distributions to your partners, they're not going to have the cash to pay those taxes and they're not going to be very happy. Okay, so my first suggestion is to pay out enough as an estimate to cover a chunk of those estimated tax payments. Okay, and you're not going to be able to do this exact because every partner is going to be in a different tax bracket. They're going to have income from other places that affect it. It's not going to be an exact science. But I do recommend starting by using my estimated tax calculator. The link is in the description, but I'll also put it in the comments. But at a minimum, if you don't want to deal with this calculator, you don't want to do anything at a minimum, I would say your distribution to cover taxes for your partners should be 30% of their anticipated taxable income for the year. So at the very top level, easiest level, what that's saying is you sit with your tax planner, you look at your numbers for the year, and you're anticipating $100,000 in total business income for your whole partnership, right? $100,000 in taxable income, and you have two partners, 50-50, right? So each partner is going to have $50,000 in taxable income to report on their tax return. I would make a distribution of at least 30% of that. And pro tip right here, when you make this distribution, specifically tell your partners that this is a distribution to cover the taxes on their anticipated partnership income. All right, you guys, we have so many clients who are big partnerships that we don't necessarily do the tax return on, but we do the individual's tax return. And they get these distributions and they're like, okay, great, this is my money from the year. And they invest it, they spend it, whatever. And then when tax time comes, they don't have any cash left out of that distribution. And they're left with this huge tax bill that they don't have cash for. Okay, so you can do a huge favor to your partners and alleviate a lot of headaches by telling them that this distribution is to cover your anticipated tax liability from your partnership income. All right, so that is step one. I always recommend making sure you make a distribution to cover the taxes that each of your partners is going to likely have because of the income made from the partnership. All right, and then my step two comes back, and before you distribute out any more than that, make sure you have that emergency business reserve built up. Okay. So build that business reserve up, again, 3 to 9 months of expenses to cover that business. And those managing partners, whether you have one managing partner or a team of managing partners, they should really be the ones discussing how many months of reserve they want. All right. Again, I recommend a separate bank account for this, out of sight, out of mind. If the partnership has that amount already set aside, great, perfect. If not, create a plan to get there. All right, maybe you're putting a certain amount aside from each sale if you're selling something big. Maybe you're putting a certain amount each month into this reserve, but make a plan to get to that reserve amount, okay? Then once you're at that reserve amount, boom, emergency fund is set. We've made distributions to each of our partners to cover their anticipated taxes. We still have $10,000, that we would like to distribute out. Great. Then you can distribute out additional money to your partners at that time. But covering taxes, a distribution to cover taxes, and an emergency fund, those two things need to be done before you consider distributing out any additional cash. So I don't see any comments in the Facebook group, so that's fantastic. I hope that means y'all are understanding. So that's it for training today. And next week, you guys, we're going back to the basics. I'm going back to Income 101, the lingo. So we're going to talk about what's your gross revenue, what is cost of goods sold, your expenses, net profit. What do those terms mean and why are they important? All right, so we're going to back to the basics next week. All right, and then last but not least, I want to remind you, or maybe tell you for the first time if you're hearing this, that PPP consultations are available now to schedule. So what is it? What is the PPP consultation? Do I need one? Let's chat about that real quick. You guys, I have spent hundreds of hours over the past 5-ish months, learning all the ins and outs of PPP and EIDL. So if you don't have a PPP, but maybe an EIDL, keep listening. All right. And I've recorded dozens and dozens of videos for you guys to try and trainings to help you guys as much as possible, to help share this info with you, to get you through this as much as possible, to get you through all this chaos. But there, I am getting tons and tons of requests from people who do want more individualized help, who want to take it a step further, who have specific questions about their PPP or their EIDL, how to spend their money, how to maximize forgiveness. Right now, we're getting close to where applications for forgiveness can start being submitted. So you're going to have questions about that. So here's your chance to chat with me one-on-one, okay? Instead of having to just listen to what I have to say and hope that I'm talking about what you need. You can ask me your very, very specific PPP and EIDL questions. So they're going to be 30-minute consultations. If you need more, you can schedule more than one, or you can schedule another one down the road. That's totally fine. And they are for current clients and non-current clients. So even if you are not a current Bree Beers and Associates client, you can schedule a PPP consultation with me. I don't need to have your whole tax background to be able to help you guys. Okay. I've been helping other accountants and bookkeepers as well who might need just a little bit of extra guidance and support. If you're a business owner, but you want to have a call with me and your bookkeeper accountant, we can do that. I'm pretty much open to whatever you guys need. So just get on the calendar, get them scheduled. We'll do a Zoom meeting. So you'll get a recording of your Zoom meeting so you can reference back to it. So the link to make these consultations, that is in the job description in the live description, but I am going to put it here so it's there as well. And right now you'll see that the availability is kind of limited, but if slots begin to fill up, you guys, I will juggle my schedule around to accommodate to open it up more. But first come, first serve. So if you're time constrained or you definitely want to get in as soon as possible, get in there now. And signing up is super easy. The link's right there. Click on the link, pick the schedule, or click on the link. There we go, to schedule. You'll be directed to my calendar where you can pick your appointment time and date. And then there's a short intake form just to get some information from you about what your questions are. And then you'll put in your payment information and boom. So that's it. All right, you guys, thank you for joining me while I was on vacation and while I'm traveling. If you guys have any questions, use the Money, Tax, and Finance group to ask those. And otherwise, I will see you a week from today, you guys. Have a good one. Have a good week.